And now as we begin our journey into 2023, here you can see just where we are on the average side and where we are on just the daily. So you can see that we're following the trend that we saw in 2021. It's obviously still well below where we were in 2022, but it's going to trend up. You can see how it starts to go higher, and then it flatlines for the most part, and that's what we see happening here. You know, again, that kind of grind up when you look at activity. So the previous week it was 12.02 million. This week it was 13.22 million. And that's something where, you know, next week it'll be something closer to about, you know, let's call it 13.7 is where we're going to be. It's just, we're going to be just below, let's call it 300 to 500,000 barrels below where we were in 2022, where we were in 2021. 2022, where we were in 2019, just because you have that disconnect between the weakness on the gasoline side is something that is a bit real and something that's going to stick around for a while. And the swing is really going to be on the distillate side. And with the fairly warm weather, at least going through till the, let's call it January 20th to 25th, you're going to get some of that cool weather, that warmer weather that will reduce demand. We will get a bit of a bump in trucking, but it's not going to be enough to really shift things too much to really put us back into the quote unquote normal. If you look from 17 to 19, we're still going to be below that, but track it seasonally. So we will get a decent bump from Martin Luther King weekend, you know, but that's factored into the data. So it's not like we're going to surprise anything really to the upside. So then, and by surprise to the upside, I just mean in terms of, rate of change, so any of these big movements. So then when we start breaking into its pieces, distillate had a small draw of 1.07 million. That was driven by pad 3, which had a draw of 2.8, and everywhere else just had fairly small builds. But when you start looking at some of the flows, you know, we want to look at where are exports going, and exports might slow a bit when you look at what is coming from the U.S. into Europe. So distillate exports dropped 468,000 barrels a day. But now, if you remember, the February 5th is the restrictions on imports from Russia. So right now, everything is focused on buying as much of that Russian product as they can, trying to lock that up. And that's, again, going to reduce some of the purchasing from here, maximizing the purchasing from Russia. So we should get a little bit of a decline on the export side, which will put a little bit of a build in pad 3. And then everything else is going to be more weather dependent, but you're starting at a very low end. Imports were up 95,000 barrels a day. You know, we should see imports remaining a bit more elevated into pad 1, because even though we are getting that warming scenario, we're still well below the 5-year average. There's still more than enough storage capacity, which means pricing is going to be accretive. If you're coming from some of these other markets into the Atlantic Basin, you'll be coming into pad 1 or, you know, obviously the East Coast. So that's something that will be fairly stable, but you can see the disconnect on just where that dot is. So it's the second lowest it's ever been. So even if you get a little bit of a bump, you still have a lot of wood to chop. And then as you go through the end, you know, really through February into March is where you continue to see the draws. The question is always going to be, what is the rate of change? If it gets much colder, as there is some potential with the polar vortex, as we get into the end of January and the first week, 2 weeks of Feb, that could create some additional problems when you're looking at demand. But at the same time as you look at storage. Diesel front month on the crack side, you can see that it's right at about 57. As we were saying, just there is that support keeping it just because storage is fairly low. Even as demand has slowed, you still have that disconnect between storage, where things are coming through. Obviously, as crude prices have come up, it'll help support a bit. So again, this is where we think it lives. Then the question is, as gasoline weakens, where is the diesel crack? And if the diesel crack weakens too much, gasoline's not going to support you. You could start to see economic run cuts, which is something that is more likely in Asia. And as we get into segment 3, we're going to talk more about where the refining activity is going to come from, because as China ramps up, other places may ramp down, and what are some of the economics and drivers behind that. So when you look at distillate in pad 1, obviously it's the new all-time low, new seasonally adjusted all-time low. Yeah, we don't see that adjusting too much. You'll start to see some builds that might be a bit counter-seasonal, but really the rate of change shows you that we will get that drop. The question is going to be, what does that rate look like? And do we take out where we were last year in terms of storage? Pad 3, right at the 29-year average, so not too much one way or the other. It's right around actually where we were, just above where we were in 2022. So we should start to see some of those builds as well, just because exports will slow a bit, and you'll get some of that additional as refining comes back. So remember, you had exports slow, but you also had refining activity, specifically in Pad 3, really drop off. So as Pad 3 ramps back up, exports remain a bit below, let's say right around the 5-year average. That'll put additional product into the Pad 3 storage. Product demand, you can see right around the seasonal levels. It's going to stay right around the 5-year. We don't see too much of a deviation at this point. Typically, there'll be a bit of a makeup period, which we had just because it was so cold during that Christmas week. So now that we've had that bump, if the next one should probably be just below that 5-year average, just because you'll have some of the flatlining on the trucking side, and obviously demand has slowed. And here's when you look at some of the trucking, you had a little bit of that bounce, but now we see things leveling off. And as we said, settling closer to, like, if you use that demand index, closer to about 57 as we go into the end of Jan. On the rail traffic side, if you remember last week, we said that we expected to see a sizable bump in the different components: coal, farm products, forest, grains, more grains, farm products, ores, vehicles, petroleum products. So again, those are some of those key things in terms of the piece, but intermodal is going to be the problem. And I don't know if you guys saw the CSX commentary where they saw a lot of weakness on the intermodal front. That's something that we do think continues, and that's going to be a problem. So we will get some benefits from other sides like grains, coal, chemicals, as we said last year into this year. Petchem demand very weak. Petchem volumes, utilization rates low. Chems is going to be a headwind. All the other spots should be fairly good, but again, it's going to be the intermodal that is going to be an underlying problem. That is where we see some of that concern going forward. Here's just putting into perspective, some of that warmth that we've seen in terms of being well above normal. It's essentially from the middle of the country all the way to the East Coast. We're going to be fairly sizably above normal, which is what has been factored into the diesel side, the heating oil side, as well as the natural gas front. Now the question is, because there's been a fairly sizable strengthening of the polar vortex, when that dips, what is that going to look like? When is that going to happen? Does it happen, or does it maintain its status up at the top? Those are going to be things that we're going to be looking at. So far, the European model is showing a bit of a cool down, but again, that doesn't happen till the end of Jan into the beginning of Feb. So we're still going to have some of this warmth ahead of us, which is going to impact some of that heating oil demand, bringing that distillate demand overall lower, which is why we do see some pressure in pricing. Obviously, storage being so low helps to offset that, but you get an idea of some of those headwinds going into the first month of the year. Gasoline sizable build of 4.11 million barrels, and it's important to remember that's coming with refining capacity super low. And that's going to be a problem because we don't see a huge bump in gasoline demand. It'll be 5-7% better than what we had this week, but that doesn't mean that we're back to normal. And there's going to be some of those headwinds that'll continue while imports remain fairly elevated. So imports were down just 35,000 barrels a day, but you can see that's still above the 5-year, and we're still going to see some of those flows coming through because Europe's at a record. There's a lot of there's a lot of gasoline sitting in storage. So now when we look at the different levels, we do see some of these builds. But as you can see from the lines here in those charts, we normally get builds. So the question is going to be the rate of change, and is it more aggressive? Is it something that's going to go much higher? So we see a fairly aggressive build for the first couple of weeks of the year. And when you look at blending components, that's something that we think is really kind of telling, where blending components only had a build of 2.97 million, but against the 5-year, against the year over year, it's still much higher. And I think that gives you an idea of where that trend's going to go, because we're just not seeing the blending demand. We're not seeing a lot of that demand in general. Blending components give you an idea of where we are. We closed right around the flatlined a bit just because of the refining issues. As refiners remain down, this obviously pulls some of this excess out of storage. But with petchem just not seeing any demand, utilization rates remaining super low, that's going to put more in the blending component side. So we do expect to see a sizable increase on the storage front, which will impact prices. Good for the consumer, especially if you buy plus or premium. Gas Buddy, according to Gas Buddy, the demand rose, but they still modeled about 7.67 million barrels a day of demand. The EIA came in at 7.55. So again, there's still some of that back and forth where we're going to have some of the movement. As now, Gas Buddy is modeling, I think it's a 4 or 5, I think 5.1% increase from week 1 into week 2. We see something similar, again, getting us closer to that 8.2, 8.3 million barrels a day number. And then remember that Martin Luther King weekend, there's typically a big skiing weekend, depending on some of those short vacations, because sometimes people need vacations from their vacation of dealing with family over the holidays. Now you look at TomTom congestion, you can see that there is that sizable bounce following the holidays, still below the 4-week on a 4-week average basis. But as we've been saying, it's just going to be below normal, but you're starting to see some of that normalize a bit. China had a nice bounce. Now that's twofold. For those that don't know, the Chinese New Year holiday starts on the 18th. So you do get some of that movement ahead of time, but you also have a reopening. So you are getting that sizable bump as people start to get into more normalized, and doing things that they have put off, because there's also been some major cities where COVID infections have kind of crested and started to drop. That gives people the motivation. I can go out, it's a bit safer, and that's where we're starting to see some of that demand as well. Now, on the U.S. pricing side, you can see that diesel pricing has continued to weaken as gasoline has been kind of flatlined a bit. We do see gasoline demand just coming down a touch. There's been some hiccups, obviously, with refining capacity, obviously with some of those issues, which is going to support some of that pricing premium, but versus where we started, but nothing too aggressive. So we do expect some of that to come down a touch, where diesel will soften a bit more, just given where things are on the heating oil side. Now, when we start looking at gasoline demand, here you can see that we're just over where we were in 2021. We expect to see a bounce, but still be well below average, and really follow the rate of change that you see from 2021 and have that peak at a fairly low end, something similar, but it'll be above where it was in 2021, just not where it should be if you compare it to the other 9 years. Now, when we start looking at propylene had a drop of 2.09 million, still well above the 5-year, well above last year. And it's, again, the warming issues, the lack of petchem demand is going to keep pressure on that and going to keep storage very elevated. Now, when we look at the jet fuel front, there was a small draw of 230,000 barrels. 5.1 below the 5-year average, just 0.5 below year over year. But you can see that we're still kind of in no man's land when you're looking at demand, and we just expect demand to remain fairly stable here. On a 4-week rolling average, you get an idea of where we are in terms of the weekly growth. We're still, fairly below 2019 levels when you look at the different pricing points, different activity. Different activity points, and that's going to be continuous. Let's call it anywhere between 5 4 to 5% below 2019. So getting much closer, just really not back to that level. And it's not so much because people aren't traveling as much. It's because airlines are just jamming you in without empty seats. So you now, and I don't know if anyone tracks this because I've unfortunately been traveling a bit more. We've seen that there's a ton of people now on standby, 10, 20 people deep on standby, because they're trying to not add planes. They're trying to maximize utilization rates. And then when you look at the weekly growth, if you go abroad, you can see that we're about 10% below 2019 levels. And that's something that we see continuing. And the TSA passenger data, you get an idea of, we're below where we were in 2020, 2019, but yeah, again, right, not a crazy down. We're not like where we were in 2021 or 2022. And that's something that we think is going to be continuous, of just below those peaks and valleys as we progress through the remainder of the year. Global passenger flight schedules for the 12 weeks ahead increased 1.04 from last week. Number of passenger flights over the week of January 3rd to 9 grew by 0.2. So again, still something that's fairly minimal versus where we have been against historics. And then open table, as we were saying, as we got out of New Year's, as we got into more of a normal week, expected to see a bit of a drop. U.S. is down 5 to 6%, and realistically that should pull down the global to be down, let's call it 1 to 2%. We do expect that to get worse as we progress through the year, as people just struggle with again, food, inflation pricing, especially when you go abroad. So that's what we have for you on the U.S. side and some of the refined product front. In the next segment, we're going to go abroad, look at some of the physical markets, some of the different shifts around the world on the refining side, as well as crude front.